Hi there, welcome to Nepi Invest. ASX stocks breaking out, reporting season edition. So we are in February, which is reporting season, and we've just finished the third week of February, which tends to be the busiest week when it comes to companies releasing their reports, the half yearly or yearly reports. So because we have a lot of companies doing that, we see a plethora of opportunities opening up. So we have seen quite a few companies' stock price looking like they're starting to break out or have already broken out. Now, what I tend to do on each and every day during reporting season is just before trading starts, I go through each announcement or reporting announcement, and I just write down all the companies that are reporting for the day. And I don't act upon those reports. I do have a brief look at some of them, and sometimes I come out with initial impression. Oh, that's quite bullish, that's quite bearish, or that looks quite good or quite bad. But I don't act upon it because the market could react complete opposite to the way I would have reacted. And we have seen that, or we did see that on Friday, the 19th of February. I'll get into an example of self-wealth. Now, what I do though is at the end of the trading day is I go back through all those companies that did report and see how their market reacted to the release of the report. And I find to react upon the market's reaction is a much more powerful signal, because the way I look at it is collectively the market is more intelligent than I am, smarter than I am, and it knows more than I. So if I react to how the market reacts, that's an important thing, a good way to look at it. And again, I'll just show you a self-wealth situation, which the market reacted completely opposite to the way I would have reacted. So this is the self-wealth. They released their half-yearly report on Friday, the 19th of February. So initially on the release of the report, I did actually look at it briefly, and my first thought was, oh, this is really good, and the market is going to react quite positively to it. And it did. So the market opened and the share price of self-wealth went up 5% at open. So the market was thinking like I was. But when I looked at the share price at the close of the day, it was down 10%. So there was a 15% swing in the share price of self-wealth during the day. You can see that in the share price or the chart here. That massive red day on the last day of trading, the share price almost got to 80 cents and finished the day at 67 cents. So in some way, the market thought differently than what I thought. I don't know why. It still looks quite bullish. I had another look at it now. And this could be a potential buy, because even though the market collectively might be smarter than you, it's not always smarter than you. Sometimes you can see things that the market can't see, and that's one advantage sometimes we have over the overall market. And this could be a situation like that. But there was something in self-wealth's report that the market didn't like, or it was just the weakness of the overall market. So the XGO fell 1.4% for the day, and maybe that's why self-wealth's share price went down. I don't know, but this was negative. This was a negative reaction by the market, and there is a chance that when the market opens on Monday, the 22nd of February, this could shoot up quite a bit, because sometimes there is a delayed reaction from the market, and we saw that with Treasury wines, and I'll get into Treasury wines in a few slides or so. Well, I said a few slides. It's actually the next slide. So this is Treasury Wines Estates, and they released their announcement was the 17th of February. And the day before they released the announcement, there was a massive decrease in share price. Share price went all the way down to $9, and for some reason, maybe it was a fund manager selling out. I don't know. There was a really good recovery with the share price, and you see that candlestick. That was massively long tail, and that's quite a bullish signal. Then I think maybe the fund manager or whoever was selling out was fearful of the release of the half-yearly report that was going to be done the next day. Now, on the day of the announcement, the share price didn't do much. It hovered around $10. At times it was above $10, at times it was below $10. So there was lack of reaction from the market, which I was hoping for a more positive reaction. And we got that positive reaction the next day. I don't know what drove that positive reaction. I don't know if there were some fund managers who looked over it during the night and saw, oh wow, this was positive. But they drove the share price higher on the following day. And then on the Friday, we did see a bit of weakness coming back with the share price pulling back 6%. But this looks fairly bullish, particularly if the share price gets towards $10.50. That would be an automatic buy signal for me. So this looks like the share price of Treasury Wines is potentially breaking out. But the last time this happened was in August 2020, which I don't show here. The market reacted quite positively to the release of their report, their financial report in that month. But then 2 days or 3 days after the release of the report, Chinese government came out and accusing Australian winemakers of dumping their wine into the Chinese market. And that put, substantial pressure under the Treasury wine share price. So sometimes even if our share price looks like it's breaking up, there could be some other factor at play in the future that could put a halt to that breaking up. But this looks pretty good for Treasury wine and its shareholders. Now, I always like to go back in the past because you can learn a lot just by looking at past charts. And so Treasury wine estates, you can see a really good uptrend that developed in 2015 and lasted all the way to 2018. Share price went from $5 to $20. So you would have made a four-bagger if you held during that time, which is not a bad thing during 3 years. You can see the share price high, $20, and right now around $10 or so, just above $10 now. We can see there is some good upside to the share price if management can turn things around. And that's a big question moving forward, whether management can turn things around. There are some people who believe, and why they're shareholders of Treasury wine, that people will be drinking more of Treasury wines in the future than they do now, and that's why they're bullish about Treasury wines for the next 5 to 10 years. It's not a bad thesis because there is, a very good chance that Treasury wines, their products will be drunk more around the world. It's a possibility, but it's not an absolute. Now, for full disclosure purpose, some of these companies I have bought in because of these very positive announcements that they've released to market, and EML Payments is one example of that. You can see when they released their half-yearly report to the market, the share price increased 16% on significant volume. This is what is called a breakout. There are some people who would refuse to buy EML Payments simply because of two of reasons. Share price has increased 16%, and because of recency bias, they're reluctant to buy in, and because there's a bit of a gap up, and people always believe, or some people always believe, that gaps always fill. It's not the case, particularly if there's a breakout gap or breakaway gap, and this is potentially a breakaway gap. So I did buy in at $5.10 in EML because I think there is potential that this could be the beginning of substantial long-term uptrend in their share price. So again, if we go back to 10-year weekly chart, we can see, well, this is a sort of a sad situation for me because I was an EML shareholder way back in 2013 and sold out the beginning of 2014 because the share price had risen a little bit, and I thought I was the genius, and then if I just held on, was patient. And this is why you ride your winners is a very successful strategy for a lot of investors. I should have just, ride one winner. I could have sold out at $5 or whatnot. So anyway, just looking at this chart, you can see 2019 was an extraordinary year for EML, and the shareholder share price went from $1.50 all the way up to $5. Then the share price really took a hit during the COVID-19 financial panic, and now it's recovering and is heading towards its all-time high. If it goes above its all-time high, that will be fairly bullish moving forward. You look, see some of the numbers there. Market cap 1.9 billion, revenue substantially higher than the previous trailing 12 months, and operating cash flow significantly higher as well, because the reason why the market has reacted quite positively was a substantial increase in some of the financial numbers that they gave us in the last half-yearly report. Pac Group is another company I bought in. I bought this company on the 19th of February, and this looks like a classic breakout signal. Last 3 trading days, and these they released their half-yearly on the 17th, so that was the first big green day. We can see a substantial increase in revenue. Each day it increases in revenue. So that as the market digests this announcement or this report from Pac Group, they like it more and more, and it's pulled through $3 on really good volume. And this is a very bullish looking chart, and when I show you the next chart for Pac Group, you'll understand why it's even more bullish. And just in the numbers there, market cap $1 billion, revenue $1.8 billion, operating cash flow $226 million. So even those financial numbers suggest this could be a cheap play. So Pac Group is another company I've held in the past. So I held this from just after IPO and then sold out in the beginning of 2017. So that was a pretty good time trade for me. And the main reason I sold out was some negative news, and I want to always try to sell out on negative news, and that negative news was the start of a long-term downtrend, which might be just turning now. And in fact, the reason $3, I haven't got it here, but $3 or just under $3 was a pretty good resistance level. If you go back to 2019, the share price was struggling to get above that resistance level a couple of times, and now it's pulled through that. So right now we're at a 2-year high with the Pac Group share price, and that's quite bullish for me. Even looking at the weekly chart here, it looks like it's beginning of an uptrend, and again, that's quite bullish. So I think there is potential here for the share price of Pac Group to test their previous high, which was $7. If it tests their previous high of $7, this is going to be 100% gain for shareholders if they're able to hold through that period. And I mentioned in the last slide about how just under $3 was a resistance level. And I've just put it here that $3 level, just under it, is the resistance level that was formed back in 2019. The share price finished at $3.06 at the end of trading on Friday, and it's pulled through that on good volume. So a fairly bullish looking chart here. This is a 5-year weekly, a 2-year high in the share price, and I'm looking at a fairly bullish signal right here with the Pac Group share price. So that's the main reason I bought in at $2.98, which is just above that resistance level. Now, since I did Pac Group, I really had to do Aurora, and particularly because they also show a bit of a breakout signal. So if you don't know, Pac Group and Aurora are sort of in the same sort of sector field. If you don't know what Aurora does, just go to some of your food you have in your pantry and look at some of the packaging and look at the symbol. You'll actually see an Aurora symbol on some of those packaging. So they are a packager. Best way to put it. I think they're the second biggest packager in Australia, the number one, and then the 5th biggest packager in America. I could be mistaken with that. So a little bit bigger company than Pac Group. You can see the market cap 2.7 billion, revenue 3.5, and operating cash flow 107 million. So I think Pac Group is the better value, but maybe Aurora is the better quality company. Anyway, I'm not sure they released the half yearly yet, Aurora, but they might have. I can't remember now. But the share price is showing some breakout signals here. We are a 6-month high. Share price again, just like Pac Group, did increase, even though the overall market had a down day. So it finished the week at $2.95. And this is the 5-year weekly for Aurora. So a good uptrend up until the middle of 2018. And then we've seen a bit of a downtrend since then. So this could be the turnaround, or it could be just another short-term peak. It's right at a bit of resistance level. You can see the last peak back in the end of 2020 was around about these levels, not the end of 2020, so the middle of 2020, sorry, was around these levels. So if it can break through that resistance level, that would be quite a bullish signal. Next company I'll be looking at is Nero. Ticker code is EGG. So if you love eggs, maybe Nero is a sort of company for you. But when I look at their financials, this company becomes more and more interesting. Market cap 257 million, revenue 328, operating cash flow for the trailing 12 months 52, and their most recent half year was pretty good numbers, fairly substantial increases on the previous half yearly numbers. And you can see that in the share price. We can see a couple of breakouts. The first breakout or breakaway gap was in October of last year. The share price went from $1.60 to $1.80. It did fall away a little bit in the subsequent month, but it just kept on rising after that. And the release of the half-year report just over a week ago, the share price went from about $2.15 to $2.40, and it's kept rising ever since. So even though the share price has been rising, the valuation of this company looks really attractive. I think they have a P of around 12 now. So at this moment, I'm going to do a little bit more research on a Nero. I'm hoping the share price pulls back towards maybe $2.50, which will be a better price to buy into. But Nero does intrigue me right here. So a little bit more research on this company. And this is their weekly chart going back to 2018. You can see they're really affected by the COVID-19 financial panic. The share price got below $1, so that would have been a really good buy. But you can see there was an uptrend before that. Bit of a weakness in the uptrend leading into the start of 2020, but this uptrend over the past almost year or so has been looking very powerful, and the share price right now is at an all-time high. And some people are very hesitant to buy into companies when the share price is at an all-time high, but usually there's a reason why the share price is an all-time high, and it's usually for good reasons, not bad reasons. So now I'm going to focus on a couple of companies that released their half-yearly report on Friday, the 19th of February. And these are two companies where the market reacted the complete opposite to how I would have reacted. Now, a possibility behind this is sometimes the market reaction is based off its expectations. So Lovisa profits, everything was down, but the market could have been expecting a worse performance than what they gave. So the market reaction is all about expectations and how the company succeeded in fulfilling those expectations or missed those expectations. So even though on initial impressions, the results of Lovisa looked pretty bad, it could have been the fact that the results were better than the market expected. And maybe that's why the Lovisa share price rose 20% in one day on the release of this announcement. So this is another example of a potential breakaway that's forming, and the share price could just keep on going higher from here. I won't buy in right now. I'm going to keep a lookout on the share price over the next few days because it could fall away. There is that potential. And when you look at the financial numbers, market cap of 1.2 billion, operating cash flow 81 million. For a retail company, that's quite low. So I want to see better numbers than that. And my other concern is retail numbers in Australia were very weak for the previous month. I won't say weak, but they were much lower than expected. I think the expectations were something like 2.2% growth for the month, only 0.6. So that could have an effect upon retailer groups, companies moving forward. The other company was Cochlear. Again, when my initial impression on the release of the results was negative, everything was down. But again, potentially the market might have been expecting worse numbers than what Cochlear gave us. And this is a potential another breakaway. You can see a good increase in share price on good volume. Market cap 13.4 billion. Over the last 12 months or so, though, the operating cash flow has been negative to the tune of 200 million. So that is one slight concern. It could be just a one-off because of COVID-19, but it's something you have to keep in mind. This is a highly valued company. And a funny story about Cochlear, I was listening to a podcast maybe 6 months ago, and in this podcast they have two guests, and it's a valued sort of based podcast. And the two guests were asked, what are two value companies that you have bought into that you quite like? And one of them's named Seek, and the other one named Cochlear. And when you think of value, you don't think of Seek or Cochlear into traditional value sense. So this is not a value play at all. Cochlear is quite expensive because I think there's a lot of expectations about this company moving forward. So that's all I got on my ASX stocks breaking out reporting season edition. Hope you have liked this episode. I've tried to do this fairly quick because I don't have much time on my hands. So hopefully there's not too many mistakes in this, but it's okay to have mistakes because that's how you learn. If you do have any comments, leave in the comments section. I will maybe take my time answering those, but otherwise I'm not a financial advisor. So even though I've showed you some companies, the whole point of me doing these videos is to share some ideas, and it's up to you to act upon those ideas. Maybe I've given you some inspiration to further your research on one of these companies. But anyway, I'm not an advisor. If you do need advice, make sure you seek out someone who is qualified. That's all for this video. Have a good day. Bye.